Hello, everyone. We're just going to give a few more minutes to get people coming into the room. But happy Wednesday or Thursday now, and happy March. If you guys have any, while we get started, if you guys want to put in the chat any questions that you want us to go over directly, or just share, hey, which areas or where do you live? I know, Jill, you're over in Virginia, but put it all in the chat just so we know who we're speaking to in the group here. I'll just give a few more seconds to get people in and situated. Thank you all for joining us today. Cupertino, awesome. Great. Perfect. So we'll go ahead and get started. And my name is Jennie Locke. If you don't know who I am a local real estate agent here in the Bay Area. And we'll dive into a little bit more about my background and how I got into real estate as well too. And today we are going to go over the home buying and financing. And we have great partners here to go over what it looks like in today's market. So just to give another detailed introduction of myself, I am the founder of Zen Coast Homes and also Zen Coast University. And I graduated from USC. I see a few other USC folks here, Troy, some other friends from school. So excited to share my knowledge with you guys. I graduated from business school, Marshall School of Business for undergrad, and then also went into working the corporate world over at Oracle after graduation. And at that time, I was able to buy my first house at the age of 23 years old. And I'll share a little bit more about that as well too, where we leveraged a home equity line of credit from my parents' house and got a mortgage on my own at the age of 23, rented out the other rooms, and made some great equity and everything from that. So that home has made almost like $80,000 per year in equity growth, and was able to move that. I was like, wow, I'm making more in my home than I am in my job here. So like I wanted to educate others on how to buy real estate and get into it and realize, hey, it's not that scary. Initially, I had a goal of buying at 28 years old, so I was able to surpass my goal at 23 years old. And I was awarded the National Association of Realtors 30 Under 30. We helped over 500 families with their real estate goals here in the Bay Area, but we do have partners around the country to be able to help you. We have some partners here in Virginia as well too on the call and all around. So that's where this is going to pertain to not just people here in the Bay Area, but all around the country. And I have over 100 plus units. So I'm myself a buyer as well too. So I've gone through your shoes of like learning everything, figuring what the details are from the different types of loan products and kind of the pitfalls from inspections and such that we'll go over too. And we, as mentioned, we have another company that I founded called Zen Coast University. So we coach on how to shift your mindset to be able to build passive income through real estate. So we've been able to own multiple units across the country, and that is a great little passive income, my future retirement, helping support my future children's college education, my parents' medical support as well too. So that's a little bit background on me. And so just going back to give you some of the numbers, I bought my first home in 2016, bought it for $870,000. We leveraged a home equity line of credit. So my parents bought their home probably like 15 years prior and then built equity on their home. So you can actually borrow from the equity as from it, and it's an interest only type product, so it's not too crazy expensive. So that we leveraged a $400,000 from the equity that my parents from their house in Brooklyn to be able to put for the down payment. Got the mortgage 470 all on my own. So to give you rough numbers, you can borrow about 4 to 5 times what you make. So if you're making about $100,000, you can borrow about $400,000 to $500,000, depending on your type of loan and your credit and your income and other factors as well too. But about 4 to 5 times what you make in today's interest rate environment. And just know that that is going to change. And I bought my first house. I house hacked. Rates back then were about 3.75%. And house hacked covered the mortgage. And I did a cash out refinance in 2020. I actually paid for a higher rate afterwards. But I realized, hey, I wanted to use that equity I built to shift over and buy other investments out of area. And Asad here, who is our lender with US Bank, actually helped me with the refinance. But in a short amount of time, 4 years, it went from 870 to 1.23 million. So that's when I mentioned, hey, I was making about $80,000 of equity in my home, where it was more than what I was getting paid at Oracle. So I decided to make that shift and educate others here. So then been able to scale up to over 200 plus rental properties with my husband, and in different states in Alabama, Texas, Tennessee, Utah, Missouri, and built about $40,000 of monthly cash flow from those properties. And hey, that's again my retirement plan, future college education fund for my children's too. And with being able to start with my property from the first one, it was able to build equity, that money, and be able to roll that over into getting my dream house. And my parents are immigrants from China, and they worked 14-hour days, 7 days a week in a clothing factory. So I always had a dream to help them retire. So I was actually able to do that last year and get them a home as well too, through the power of real estate. And we were able to get a lot of tax deductions and other write-offs as well too, which we'll share a little bit about too. And if people are just joining in, if you have any specific topics that you want to go over or questions, type it in the chat. We'll make sure we'll go over it during this call or at the Q&A. And just to share a little bit of our team. So we have a team here in the Bay Area, and we also have support of team members across the country as well too, and across the world. We have main agents here. So you'll see these folks to be able to help you buy a home or sell a home. And some of the great benefits of owning real estate. So why I love real estate compared to some other investments, such like stocks or cryptocurrency or other things, is that it's something that is tangible. You can see it, you can feel it, and there's also a lot of great tax deductions from it. So by owning a home, you get happiness and freedom. You can decorate your wall with whatever you want to do, paint colors in your house, like whatever you want to do. I know any landlord wouldn't want this dark of a wall color, like for you to paint it, but you can do and hang whatever you want. The tax advantages. So some of the tax advantages, you get $10,000 of property tax deduction on your primary home. And for rental properties, you are able to deduct all the property taxes. And then you get up to $750,000 of mortgage interest deduction. So whatever you're paying in the interest rate towards your mortgage, you're able to deduct that up to $750,000 for your primary home. And for your investment property, you're actually able to deduct all of that interest. And when you buy a home as a primary home, let's say you buy a house for $1 million and you are married couple, and then in 5 to 7 years, the appreciation goes up to $1.5 million. You're able to take that $500,000 tax gain for without paying any capital gains tax. So when you equate that to working income in a W-2 standard income, you probably have to make about $800,000 to be able to get that same $500,000. If you're selling stocks or other things, you still have to pay that capital gains tax. If you're selling $500,000 of stocks, that gain, you're going to have to pay that capital gains. So that's a great benefit of how we've been able to help a lot of families move up, like teachers with not a crazy high salary income, but start within a townhome, upgrade to their dream family home because they were able to reap that benefits of the tax-free capital gains tax of $500,000. You can also depreciate properties over time as well as the tax savings. For rental properties, you can depreciate over 27 and a half years. And then average appreciation yearly, even with the market shifts and the downturns, we have seen at least 4% in most areas around the country. In some areas like the Bay Area here, we've seen up to 8.92 average percent appreciation in the last few years too. Another thing is that you get consistent monthly payments as well too, versus when you're renting, you don't know what your monthly payment is going to be. Your landlord might jack up your rent or other things, or they might ask you to leave and they end up selling the place. So you have to find a new place. So it's just more consistent. You know, if you're getting a 30-year fix or like even with the adjustable rate mortgages, which Asad will talk about, it's at least fixed for 5 to 7 years. And then, of course, the equity growth as well, too, with a prime example of my home that I bought. And these are some of the families that we helped around the Bay Area. So our hashtag is to be able to unlock your potential and unlock the potential for you to build your wealth through real estate and unlock your beautiful new home. So I want to give the mic over to Asad.
Thanks, Jenny, for that introduction and the detailed background. So hi, everybody. My name is Asad Taheri. I'm with the U.S. Bank. I've been in the industry for nearly 2 decades now. I love working with first-time home buyers or investors as well, navigating through the whole lending process. In terms of U.S. Bank and our products and our niches, we have both options for a conventional mortgage as well as a portfolio mortgage, which I'll touch a little bit more in detail on both of those as we get to the slides further along. But I'm glad to be here and I'm excited to answer any questions you guys have.
And today we'll go over the mortgage rate history and what that means, and overall the home buying process, some of the do's and don'ts when buying a home, how to get pre-approved, how much you can get approved for, and some financing options, what are strategies for offers to be able to win in a competitive market, and also what the closing process and escrow process typically is. Most states work with escrow companies. Some states might work with attorneys and lawyers. And then just overall how to build equity in your home. So giving an idea of where the mortgage rates are. If we're looking at historical trends, when my parents bought a home in the 1980s, they were paying about 18% interest rate. Everyone right now is freaking about, oh, interest rates are so high right now. So right now we're seeing between 5 to 7%, but it was about 2 to 3 times as much in the 80s, and people were still purchasing properties, and note that they were able to refinance later on. So right now we're in 2023, like it was an all-time low last year. We saw rates as low as 2.25, 2.5%. But right now, like it's gone up a little bit more because they want to hedge against inflation. So some of the things that you want to be aware of when looking to buy a home is when the next meeting for the Federal Reserve is going to be. So that's going to be on March 21st of this year. So in just a few weeks, and then that's when they're going to likely increase the interest rates again, about 1/4 to 0.5% is what we're hearing. And just to note that every increase of 1% of interest rate will decrease your borrowing power and buying power by about 10%. So you can afford $1 million home right now. If you go from a 6 to 7% interest rate, it's going to decrease your buying power with the same monthly payment to about $900,000. So there's a few factors depending on your down payment and other factors too, but that's just like a rough rule of thumb where, hey, being able to look at buying and locking in an interest rate right now. And what we're saying is, hey, lock in the lower rate right now before it jumps up. And then you can always refinance later on if the rates go down in a few years too. So we say date the rate and marry the house. So we probably always hear that all around. So that's where right now the interest rates are around 6.73 on a national average, but here, like in the San Francisco Bay Area, we're looking at jumbo loans, so they're closer to around 5.75 to 6% right now on a 30-year fix. And we'll go over the different type of loan products as well. And then this is just the last few, since the last year where we were projected, it was around, we typically look at the 30 years, it was around right under 4% last year, and now it's about 6%. So it's been a little bit volatile going up, and it's probably going to go up a little bit more. So it makes sense to buy here. But note that, like, hey, you're people who bought in the 1980s at 18%, they're still super happy they bought because they got so much equity and growth from their homes. And then inflation expectations, just understanding where the inflation is. We are seeing inflation slowing down a little bit as well too. So with the inflation slowing down, then they'll likely soften the interest rate hikes consistently. And a lot of people are asking, hey, is now a good time to buy? No one size fits all answers, but we would say first time home buyers, prices have been softening and leveling off a little bit, but the entry level homes, what we have seen are very steady. So the standard 900 to 1700 square foot homes, 3-bedroom, 2-bath homes, those are constant buyer, like homes that are interested, that people are going to go after. And you can always refinance. So what a refinance means is that, like, similar to how I did a cash out refinance on my home on my first property, you can get a new loan at a lower rate. If rates go down in, like, within the next 7 years, we are projected to hear that rates will probably be in the mid 4s again. So being able to refinance back down to a lower rate. And then repeat buyers and sellers who plan to buy again, equity gain is at an all-level high. So being able to cash on that out on that equity. As I mentioned, you're able to get $500,000 of tax-free capital gains, tax-free. If you sell your home, if you bought a home for $1 million, it's worth 1.5. You get that 500K tax-free. So being able to leverage that as a down payment to move up to your next buyer. And investor buyers. So some people might be looking at investing in different properties. The rental market is booming right now. So it is definitely where, depending on which areas, but like now people are like, they might not be able to necessarily afford for the higher interest rate. So they're going to keep renting. So being able to buy those different properties as well too. And then I already mentioned that every 1 point drop in mortgage interest rate will add about adjust about 11% in your purchasing power. And then the cost of renting versus owning. So just leveraging an example here right now. Let's say if you're paying for your rent and like about $3,000. So that rent, just when I thought about it, I was like renting only a room. I even shared a room with another friend. I was only paying like $800 for a room. I shared it. It was $400, but I was like, oh, I'm still paying that towards someone else's equity and mortgage. But yes, we're leveraging an example of, let's say someone is paying $3,000 per month in rent. The average tax rate is about 35% if you are making like dual income, about 250,000. And we're leveraging about a sample purchase price about $1.7 million, mortgage interest rates about 5.75, and they're putting about 24% down. So property tax rate is, double check your specific county, but they're usually around 1 to 1.5% of your purchase price. Insurance, we put here as about $2,200 for insurance. Most homes are going to be around $1,200, $100 a month for insurance. But if you need flood insurance or fire hazard insurance extra, if it's a high fire zone, that might be a little bit more too. And average appreciation rate about 4 to 5%. So the value that you're going to be losing out on is actually in a yearly basis is about $139,000 because you're paying towards the rent, losing out on the potential appreciation, and then also the tax savings from the property tax deduction of the 10,000, and then also your mortgage interest deduction as well too. So although you think, oh, my rent is only 3,000, but it's like the monthly value of losing out on this is about 11,000 or more. So it makes sense. When we met with this client, and these are real numbers, they were like, okay, like I was going to buy a year from now, but it makes more sense for us to purchase now. And then their monthly payments, this is what their monthly payments would look like, which is actually less than the value they're losing out on. So the monthly payments typically are going to include your mortgage, which is your principal and interest, and you would need to go to a bank or a lender if you're not buying all cash to be able to get that mortgage. So Asad will go over the different types of mortgages. Property taxes are around 1.25 roughly in this area of your purchase price. And then HOAs, so that's homeowners association fees. So usually condos and townhomes or new development homes will have a homeowners association fee. But most older single family homes will not have an HOA fee. Like if it's in a gated community, it might. And insurance is going to be roughly about $100 a month. A little bit more of it, you need flood insurance. And just some of the details here that these outsized increases have raised concerns that a home price bubble is emerging. However, conditions today are quite different than in the early 2000s. Particularly in terms of credit availability, the current climb in house prices instead reflects strong demand and amidst tight supply, helped along by record low interest rates. So we're still at a fairly low interest rate market, even though people think it's super high. Just like about 7 years ago or so, like we did see 5%, 6% back then too, and we saw 18% back in the 80s. But this is what it's saying where everyone's like, oh, like, should I wait? We're heading towards a recession or something. So what caused the last recession in 2008 with the real estate downturn was that there was something called stated income financing, where people would just go to the banks. They said, hey, I make $1 million, and they would just give loans out there left and right without really checking your finances. But now banks are very stringent. They have something called a debt to income ratio, where you can only qualify for about 43 to 50% of your income. So let's say your max debt, if you're making $10,000 a month, the max debt you can have is $4,300 to $5,000 per month in your mortgage and your interest and such. And they're very stringent on credit scores and making sure they get all the documentation. So the banks are very stringent versus back in the early 2000s, anyone was able to get a loan. And the home buying process, so there's just a few steps here. The first one is meeting with your real estate professional. So we have a few folks over on our team here that will be able to help you. We would love to just go through over Zoom to go through what your guidelines and everything are. And then the next step is to get pre-approved with the lender. And Asad will go over that in detail. And then the fun part is the search for homes and then making an offer, the negotiation and contract, and then an escrow, and then final details. And we'll go over each of these a little bit more in detail today too. So I'll pass it over to Asad.
Thanks, Jenny. Now for the fun part, going through the pre-approval with you guys. This is probably the part where you guys have the most common questions is going to be, what's my max purchasing power? Important part of that is it'll help you know what range you can work with. And I typically like to pre-approve my clients for the maximum purchasing power, because that'll let you know what your max is in case you see a property that you really love and it's above the number that you were thinking. You don't have to come back to the lender for the second time and say, okay, can you review my documents again? You can, of course, borrow always less than that. And then interest rates as well. We'll go through interest rates and the different mortgage product options, 30-year fixed and the 7-year ARM. But first off, let's just kind of go through what are the basic requirements for getting pre-approved, what documents are required, just so you can have these on top of mind. So the first thing that we're going to go through is assets from a lender's perspective. That's one of the things that's going to determine your purchasing power. And in terms of assets, the way we verify it is that we need to look at 2 months bank statements. So whether it's your bank account, brokerage account, if you have any equity or stock positions, or retirement account, we'll take a look at all of those assets to verify what monies you're going to use for your down payment, your closing cost, and there's something that's called reserves. Reserves, think of it as an emergency fund that lenders want to make sure that you have to fall back on. In case something happens with employment, you can tap into that emergency account. So we look at 2 month statements. And in regards to the liquid monies like checking, savings, one thing to take note of is that any large deposit into your accounts, the underwriter has to see where that money is coming from. Your payroll deposits is completely fine because it'll show that it came from your employer. So anything outside of payroll. And what is defined as a large deposit is anything that's more than 50% of your monthly income before taxes. So if anything is more than that outside of payroll, then we'll need to see where that money is coming from. And a couple of other areas around the assets to take note of as well is cash, it can't be used. So if you have some people like to keep some money at home and maybe they're planning on using it to purchase a house. If it's deposited at the time that you get into contract, that can't be used because it's not a way that they can verify where that money came from. So the best way around that is to have that money seasoned. So put that money in your account ahead of time. And once it's seasoned in your account for 2 months, then there won't be any issues using that money. So it's important to do, these discussions ahead of time during the pre-approval stage. So once you find a home, you don't have these surprises later on. The next area is 2 pay stubs. So that's how we verify your income. We'll use your current base salary. In addition to that, if you have bonus income or restricted stock unit income, we can use that as well. Tax returns, we would only require that if you're self-employed or if you own rental property. If you're a first-time home buyer and you work for a company directly, then we don't even need your tax returns. Valid ID, this is more for residency status. So if you are a green card holder, permanent resident, or if you're here in the US on a work visa, we would just need some supporting documentation around that. Earnest money, that's the initial deposit that you make when your offer is accepted on a property. So that's essentially just going to come from your bank account, and we just need to see where that money came from. Mortgage statement. So if you own a property, we just need to see documentation around the expenses around that property, including homeowners insurance, HOA dues, things of that nature. Essentially, anything that's related to kind of what Jenny mentioned earlier that would affect your debt to income ratio, your DTI, we take that into consideration. And then some other documents to keep in mind if it's applicable. Award letters. So if you have pension, Social Security income, I recently am working with a client who gets tribal income. So if anything like that, that's an award letter, we would need an award letter, and we can use that as part of your qualifying income. Divorce documentation. So if that's applicable, we'll need the divorce decree, bankruptcy documents, retirement statements. I mentioned that earlier. We can use that towards reserves. And I already touched on US residency documents as well.
And I know when you helped my brother, like having cash value life insurance was helpful too.
Yeah, that's another asset source that we can use for reserves also. All right, get pre-approved. What do lenders consider? So I touched a little bit on the asset part. So we need to verify you have enough monies to cover the down payment, closing costs, and reserves. And then in terms of income and debt, this is kind of, I guess, what this slide is going to be talking about, the debt to income ratio. From the income component, we look at your current salary. So we don't do an average of 2 years, whatever you're currently receiving. If you've recently received a promotion, we can use your current base salary along with your bonus and your RSU. Just touching real briefly on bonus and RSU, we do need a 2-year history typically. So they want to see a 2-year performance history for bonus and restricted stock unit income because we do average it over 24 months. I have been successful in getting exceptions for borrowers who've only had 1-year history. It is an exception, but it is possible. And then in terms of debts, what do we look at to calculate it? So we'll look at your projected housing payment on the new property that you're going to buy, the mortgage payment, property taxes, insurance, HOA. And then if you have any other installment or revolving debts, so primarily like student loans, car payments, credit cards, whatever the minimum payments are on those, that's going to be the numerator portion of the debt to income ratio calculation. And then the bottom of it is your monthly income before taxes. And that's essentially how we calculate the DTI. Now, Jenny mentioned that typically the max is around 43 to 50%. That's the range we can go to work with. And again, as an example, if your salary is $10,000 a month before taxes, the max debt that you could carry is going to be between $4,500 to $5,000 inclusive of everything. So if we push it to the max, that's going to translate to your maximum purchasing power. Okay, get pre-approved and what do lenders consider? The asset part of it, we talked about that as well. And a couple of other things maybe that I didn't mention is that gift money is something that we do allow. So if you have that as a resource from your family, we can use gift money to help with the down payment and the closing costs. The only money that has to be actually the borrower's money is the reserves. That's the emergency cushion. And in terms of how much reserves is required, it's dependent on the size of your loan. If your loan amount is $1 million or less, we need 6 months of your future housing payment as a cushion. And if the loan amount is over $1 million, it's 12 months. So that would be the additional money that's required for reserves. And then in terms of the property, what's the market value of the property I want to purchase? So the way the lenders determine that is they use an independent third party, the appraiser. So the lenders actually can't really communicate directly with the appraiser because of government regulations and a lot related to what happened during the last real estate crash back in 2008. So all lenders have to work with a third party, and then that third party will help coordinate a local appraiser to accept the assignment, and they'll go to the property and do an inspection on the interior, exterior, and prepare a pretty lengthy report, 20 to 30 page report. And that'll determine what the market value of the property is. And it should hopefully match your purchase price. And that's how the lender will determine the market value. Typically, it should come in at purchase price. I've had some situations where it comes in above purchase price. That's great if it does, but it doesn't change the parameters or the process of the loan. And if it comes in below purchase price, then we can still move forward with the loan, but your down payment will be increased depending on how much the appraisal comes in lower.
Then do you need to show details on the source of the gift money beyond the name of the person who gifts it?
Yeah, very good question. Our guidelines are pretty simple around gift money, especially if it's coming, or particularly if it's coming from the US. If it's coming from a bank account in the US and not abroad, all we need is a gift letter template, which we have. And then we just need to link that money to the donor. So whether if they send it through wire, we just need a wire receipt that'll have the donor's name so it can match the gift letter. So we would not need any bank statements from the donor. We just need to link it to the donor through either a wire receipt, or if they gave you a check, a copy of the clear check. If the monies are coming from outside of the US, and I always try to ask these questions during the pre-approval stage to avoid, again, any issues after you find a home. We just have to prepare a little bit more ahead of time. The money has to be seasoned in the borrower's account for 30 days. So we'd have to have that transfer happen earlier in the process.
And just note that some countries do have limitations of how much they can send over. I know, for example, China, it always changes, but I know the last thing I heard was that they can only send $50,000 or so. So that sometimes might not even be enough to cover the earnest money deposit in certain markets here. Yeah,
you're right. I think it is about 50,000 is the max that they could send per person. And again, I guess this all goes back to try to plan ahead of time, prepare early, so that way you can try to get additional money if it's needed or whatever the scenario is. And it'll allow you to have a much stronger approval letter so you can shop around with peace of mind and know that your offer will get accepted and your loan will go through smoothly.
Yep. So get the money earlier and then season it, so there's no question.
Right.
Perfect. And then here's just an example on how much you can afford. So a great tool, just Google search Zillow affordability calculator. So we put in here 250,000 for annual income. So most banks will typically just look at your gross income before taxes here. And this is a standard W-2. It does get a little bit more complex if you are a 1099 or self-employed, because a lot of self-employed people end up taking a lot of write-offs. So those are things to be cautious and be careful of. And then your monthly debts. So they're going to consider your like, let's say your car lease payments, mortgage payments, your student loans. So Asad, can you elaborate a little bit more about how you calculate the debts and student loans, for example, and what other debts to consider?
Yeah, definitely. We'll use the numbers that show up on your credit report. So we have both options. We can do a soft credit pull or a hard credit pull. And all your liabilities, installment or revolving debts will show up on the credit report, and we'll use the minimum payment. The only type of installment that we need a little bit more info on is going to be student loans, just because lately there's been student loans that have been approved to be on deferment. So if it's been on deferment, we'll need a copy of your most recent student loan statement or the statement before it went into deferment, so we can calculate how much payment that we can apply when we calculate the debt to income ratio. But other than that, if it's like a credit card or a car loan, or if it's leased, the minimum payment should show up on the credit report, and that's what we would use. And there are sometimes ways, if you want to maximize your purchasing power a little bit higher, we can discuss options if you want to pay off certain things on your credit, whether it's a credit card, if you have a personal loan, or maybe if you have a car that's financed, not leased, if you want to consider paying that off and remove it from your debt, then we can exclude it, and that'll help you increase your purchasing power. You wouldn't have to pay it off until final loan approval. So it's not like you have to do it during the pre-approval stage, but just know that before the loan can be final approved, those debts would need to be paid off if you want us to exclude it.
And then other debts will include alimony and
Child support.
child support, and mainly student loans, car loans, and then also if you have other mortgage and leases as well too. Usually if you have rental property, most banks will take 75% of your gross rents.
Yeah, that's one way. Or we'll also look at your tax returns and determine the rental income if you have like a 2-year history of filing rental income.
Perfect. And then one question is, if my down payment is in stocks, do I need to cash it out before going through the pre-approval process?
Great question. Thanks for asking that. You don't, no. We just need to see the statements for the pre-approval, and you would need to start selling them shortly after your offer is accepted, depending how tight the close of escrow period is. Probably I would recommend to do it once your contract or once your offer is accepted, then you can begin selling it, but you don't need to do it at the pre-approval stage.
Great, thank you. And then going back to the Zillow affordability calculator, so we leverage 250K again for income, 250 for the debts, and then if you have 250,000 for the down payment, and then debt to income ratio, you're still within that comfortable budget here at 36% at a purchase price of 1.25 million. We use 5.25 as an interest rate right now. Those are typically what the rates right now are for a adjustable rate mortgage. We are seeing most borrowers by getting an adjustable rate mortgage. What that is that it is fixed for, let's say, 5 years or 7 years or 10 years. And for that rate of 5.25, what we're seeing today, and then it will readjust to what the market rate interest rate is at that time afterwards. So a lot of people are getting that just to save, because they do project that they'll either likely move and upgrade to their next home within that 5, 7, or 10-year time frame, or that they want to refinance and pull some equity out, or rates will go down within the 5, 7, or 10-year time frame too. And just quick rule of thumb that I like to use, as I mentioned, is about 4 to 5 times what you make. So this borrower, they make 250 times 5, that's about 1.25 around for a purchase price. So this is not the absolute max, and then plus your down payment. So they could go up to 1.5 million total, but we're just being a little bit more conservative at 36% for this client here. Then diving into the loan programs with Asad.
Yeah, thanks. So essentially with any bank or lender you speak with, there should be two categories of mortgages for you to consider. There's the conventional, and then there's something that's called portfolio/jumbo. Synonymous, it'll refer to the same type of product. Conventional, also, you may hear it referred to as conforming or agency. Now, with that first group, conventional products, it refers to a group of mortgage products that all banks and lenders have access to. It's the same guidelines with everybody. And some of the, I guess, the pros on that product are that it has lower credit score requirements, and they can do lower down payments, as low as 5% down payment on the conventional. They do have max loan limits in California because it's high cost in our state. It's higher than some other states. The max conventional loan limit in California is around $1,080,000. Before the Fed started increasing the rates last year around March, the conventional priced pretty well. The rates were pretty competitive, but ever since the Fed has been increasing rates, the conventional rates actually have been higher than the portfolio jumbo. So the portfolio jumbo now generally has lower rates than the conventional, and there's really nothing negative around that. Sometimes when I'm talking to clients, they're a little afraid of the word jumbo probably because of the last real estate crash, and it has some negative connotations to it. But there's really nothing bad around it. It actually has a little bit more stricter guidelines compared to the conventional, slightly higher credit requirements, and their minimum down payment is a little bit higher. We have options with 10% down on portfolio jumbo, whereas again, conventional can go as low as 5%. So those are the two types of mortgages available. One more thing, the main difference again between the two is that the portfolio is unique with every lender. They have their own guidelines because they lend their own money. And then when the mortgage closes, it stays on their books. So you'll end up making the payments to that particular bank or lender. Whereas on the conventional, it's serviced by Fannie Mae or Freddie Mac, so it could get sold to a different servicer. But again, both have their pros and cons. And when you're pre-approved, you can switch back and forth between the two. So you're not pre-approved just for one. If we see rates improve on conventional, we can always move you back to the conventional. So you're not locked in one or the other once you get pre-approved. And then some first-time homebuyer programs. There's FHA loans, which is a good product for some consumers who maybe don't have very higher credit scores. And then there's VA loans for veterans. That's a very good product because you can go with as low as 0% as your down payment, and there's no PMI, private mortgage insurance. PMI comes in, just to kind of go on a little bit of a tangent here. Anytime you do less than 20% down payment, there's something that's called PMI. Again, that stands for private mortgage insurance. Lenders feel they're taking a little bit bigger risk since the borrower is putting less than 20% down payment, so they have that mortgage insured through a PMI company. So it's an additional monthly payment you make if you do less than 20% down, but eventually the PMI can fall off once you reach 80% loan to value. You build 20% equity. So the VA loan, again, going back to that has no PMI. So that's a great niche with the VA product. And then the other two products, Home Ready and Home Possible, those are Fannie Mae and Freddie Mac products. And these are for certain income brackets. They have lower interest rates than the conventional Fannie Mae products, but you have to be able to qualify based on income. Your income can't be over a certain limit. And they have this website that we could go to, and it lets us know what the max income limit is for each census tract or zip code. And then there are options with as low as 3.5% down with FHA or Home Ready, Home Possible programs. These products, again, have lower credit score requirements than the portfolio jumbo, as low as 620, 5% down payment. And they're a little bit more flexible if there's been imperfect credit or derogatory payments. Okay, so the top 10 do's and don'ts to help us have a smooth loan process, smooth escrow once your offer is accepted. Once you apply for a pre-approval and you have your credit run after that, try to keep these in mind. Don't apply for any new credit of any kind. And this actually should just be even before you apply for a pre-approval. Whenever you guys start thinking that, hey, I'm interested in buying a property, try to keep these in mind, because when you do apply for credit, whether it's a credit card or a personal loan, you're going to have a hard inquiry on your credit report, and that'll bring down your credit score a little bit. So don't apply for any new credit of any kind. Do keep all existing credit card accounts open. So if you do close credit cards, let's say you have several cards and you make payments on time, but you feel like you don't use them and you want to just close them because it could help your credit score get better. That's maybe somebody had told you that or something. Don't do that. You want to keep your credit cards open, because when you do close them, it'll actually drop your credit score a little bit for a short period of time. Don't max out or overcharge existing credit cards. The general rule of thumb over here is if you want to try to optimize your credit score, you want to keep your credit card balances at around 10 to 15% of your high credit card limit. Anytime it goes higher than that, the credit bureaus, they have certain algorithms that kick in and it'll affect your credit score a little bit. So you want to try to keep your credit card balances as low as possible. Do keep your employment within the same company and within the same field of work. I understand sometimes personal events happen in life and you have to change employment. If it's typically within the same field of work, it should be okay. At least with my bank, we're pretty flexible with that. If you take a position, let's say if you're in the tech sector and you just change from one tech company to another, but you're still in the same line of work, even if it's in the middle of the loan process, it would be acceptable with us. But definitely keep your loan officer in the loop before it happens. Communicate with them. Communication is very important. Don't consolidate debt under one or two credit cards. And again, the reason for that is if you do that, most likely the creditor will pull your credit score or pull a credit report, and that'll affect your credit score. Do pay off collections, judgments, tax liens reported in the past tax year. Do be prepared to pay off collections if required by underwriting. So if you have a few collections on there, depending on what the balances are, the underwriter may require you to pay them off, especially if they're higher amounts. Typically, kind of general rule of thumb, if it's less than $1,000, typically we don't require you to pay it off, but it's more than $1,000, then the underwriter may require you to pay it off before closing. Number 8, do provide any documentation for satisfied judgments or past tax liens. So if that's applicable, you could always just bring it up to your loan officer, talk about that up front so it doesn't come up later on in the process. That way you can be prepared and provide the documents earlier. Do stay current on payments for all existing monthly obligations, particularly anything that is credit related, so revolving or installment debts, and also your rent payments. The rent payment is an area that the underwriter always checks before final approval. They do a verification of rent over the most recent 12 months. So if there's been any issues, or if the rent payment that you make is maybe split between a few different roommates, those are just things that it's good to discuss with your loan officer up front, so all the proper documentation can be ready early on, versus when you get in contract. Once you're in contract, you don't want to be chasing documentation. You want it to be smooth and stress-free. So it's better to take care of all these things early. And then lastly, do call us before making any financial decisions or changing to your normal routine, just to run that by us and to make sure it doesn't affect your loan or the financing process in any way.
And then for number 1, what time frame affects a newly opened credit card?
So, I mean, anytime you have a hard inquiry, it does affect your credit score, and it typically could take maybe anywhere from 3 to 4 months for that hard inquiry to kind of fall off and your credit score to slowly recover. So if you had a hard inquiry like beyond 3 to 4 months, then you should be okay. And then in regards to the credit score, every lender is a little different. With us, our ceiling is 740. So we're not as credit score driven. Doesn't matter if your credit score is 840 or 740, you still get the lowest interest rate with us. So that gives you a pretty big buffer. And if your score does drop a little bit because of the credit pull, you know you have that buffer to fall back on.
And some people might shop around different lenders. So we do recommend to get that pre-approval within the same month. So it will only show as one mortgage inquiry hit.
Yeah, that's a great point. Definitely. Yeah, you have a 1 month period to have your credit checked with a few different lenders if you're comparing, and only that first inquiry will bring down your credit score.
And then to clarify, is that 1 month like in a calendar month or like a 30-day period or?
I think it's within a 30-day period. And when I also talk to my clients, I usually recommend just to be a little bit more conservative and try to do it within a 2-week window. If you don't want to take a risk in case, I don't know, if your credits, if they do hit you with a hard inquiry, if it falls within within 3 weeks or 4 weeks. So if you are going to shop around, try to do it within maybe a 2 to 3 week window, just to be more safe and conservative.
Great. And then going into the touring homes part. So this is a fun part when we get a better understanding of what type of homes that you're going to be looking for and realize like, hey, is this going to be within your budget? So first is understanding the budget and setting reality and expectations of that as well too. So the first thing is understanding, where do you want to move to? Do you want to stay here? Do you want to move out into like not out of the city or out of state as well too, and understanding the different areas? We can refer you to agents all around the country if we're not able to help you here locally. And then first, what type of home are you looking for? So there's different types of loans, but homes from the condo home, there's manufactured homes, which is unique and different type of lending there. But then the main types of homes are going to be condos, townhomes, which do have that HOA, homeowners association. Condos are usually like either like typically a 1-story, similar to an apartment, and there is you just take care of whatever's inside. Townhomes are typically 2 to 3-story homes that are attached on one side or 2 sides, and you might have to take care of your own roof on the townhome situation, and then the exterior, the HOA might take care of. And then single family homes are other homes that are usually no HOA, but newer constructions will have an HOA. So figure out, hey, if you want a yard, if that's important, you might have to look more as a single family home. And then there's going to be multi-units, duplexes, 10plexes, and such as well too, if you're looking at investment properties. And then figuring out how many bedrooms and bathrooms do you prefer? And what is your bare minimum? Are you going to be okay with a 1.5 bath and 2 beds with maybe a den that you can convert to an extra office or something? So being a little bit more flexible in that, or if your strict criteria is a 3-bed, 2-bath. And then what are your preferred modes of transportation? Do you need to be close to train or a highway, or you want to be away from it and or need to be walking distance to the bus or a certain way to get to work or by the airport? So those are things to make sure that you consider. And then, hey, our school is going to be important. Do you want to live near a school? Sometimes people don't want to live directly across from a school because they don't want to deal with the school traffic of drop-offs and such too. Or you do want to be close to school where your kids can go to a walking distance. And then really understanding, hey, what are your future goals? Is this going to be a home that you're going to be living in for 5 to 7 years or so? Or is this going to be a forever home as well too? So that's where we usually see, hey, like if it's going to be your first or second home, it's probably not going to be a forever home. And a lot of people that we've seen, like even getting their forever home, life and things change as well too. So just understanding what do you want for the next few years here. And then also, this is very important for us. What are some cultural traditions and beliefs that are important to you? For example, within my culture, the number 4 is not that lucky and not an auspicious number. So for me, like my parents, like, and myself, I wouldn't want to get a home with the number 4 in it. So understanding what are your cultural traditions, and if, especially if you're getting gift funds from parents too, to make sure that you're going to ask them for their blessing on the home too. And then going, like, once you like a home, then figuring out what the offer process is. So there's going to be a few things called contingencies when you're putting in an offer. So the main contingency we're going to look at is either the loan contingency. So once you're pre-approved and Asad, for example, has gone through your file in detail, we are typically able to waive that loan contingency unless you're very tight onto your debt to income ratio up to that 43 to 50%. So the example that we showed on Zillow, if they were looking at a $1.5 million price point, but they don't have all the documentation quite ready yet, then we would probably put a loan contingency in. But if you're looking at a 1.25 million, you're already pre-approved at 1.5 million, you're pretty solid on getting that loan, as long as there's no major changes in your finances or your job. Appraisal. Appraisal is when they hire a third-party appraiser to give a value on the property. So they will lend a certain amount towards to ensure that if the appraisal comes in lower, below what you got it for, then you would have to come in with the difference in your down payment. If it comes in higher, they're great. You made some great equity, but you won't give in the specific, the extra money given to you. And then inspection period. So that is when you would be able to get an inspection report on the home. Some sellers will provide the inspection report up front. So we'll be able to give look at the inspection reports and see there's usually a home inspection or a termite inspection and such. Okay. And then I will pass it over to Ashley to go over the details there.
Hello, everyone. So as Jenny mentioned, when we're going through just different types of disclosure reports and thinking about our contingencies, if a seller has not provided us in inspections, or if they have, it's very important to understand what we're looking for. The main things that we will be looking for in a main inspection of a home is going to be the general reports going over electrical, foundation, roof, and plumbing. These are some of the bigger ticket items when we're thinking about a home. So it's important to understand what we're looking at. So these are things that as an agent, we'd be going through these documentations for you, but just to kind of keep in mind some of the bigger items when it comes to electrical. Sometimes on electrical, there's going to be small things like a GFCI that's maybe ungrounded. Those are a little bit easier to repair, where if we see on the inspection report that the electrical needs a whole new sub panel, that's something that we would either, add into our decision when we're coming up with a purchase price, or having potentially a seller address some of those items. And so this is just us showing us an example of some of those general inspection reports. I think on the next slide, we'll go into some of the other items. So when we do a termite inspection, what's really beneficial about a termite inspection is the inspector will actually give you an estimate on how much they think it's going to cost to repair the items that they're addressing. When you see a termite inspection, there's going to be something called Section 1. You might hear that as you're even touring homes or talking to agents. They may say that the seller has cleared Section 1. That means out of the termite report, there are multiple sections. Section 1 is the portion of the home inspection that the inspector recommends addressing right away. And so some sellers will address these in advance or once they find out about those. Typically, this Section 1 is where we're going to find out if there are any termites at the property, any fungus or dry rot. Some of those larger ticket items are going to pop up on the report in Section 1. And that's what's great about these termite reports is we have an idea here of, based on there being some evidence of subterranean termites, they've actually noted how much they believe it will be to repair that item. So we can almost calculate in how much it's going to be to address those. Please note that when we are going through these reports, these price points can sometimes be a bit inflated, because most general inspectors, they are giving an estimate of what they believe it would be to repair or, address this item. They may not be the ones addressing the item, so they will typically inflate these, just as a note for when you're going through these reports. And the termite inspection, the roof inspection, and sometimes a foundation inspector will give estimates, where a home inspection is not going to provide that. But working with an agent, a team that has experience in those, they might be able to give you some estimates on how much some of these items may cost to address. And so the next one is another important document that we will find in our disclosure package, which is called the natural hazard disclosure. This report will actually identify whether or not a home is in a flood zone, an earthquake zone, a fire zone. And so the reason that this is a very important document is, one, we do have sometimes buyers that are trying to stay out of these zones for, particular reasons, or they just don't want to have additional insurance. So if you are in the first zone, a special flood zone, your lender will actually require you to have flood insurance. For flood insurance, it can range, just as any type of insurance can range, car insurance, home insurance, that type of thing. We do see typically it is about $100 a month, just to estimate how much it could potentially cost you on top of your already homeowner's insurance to be in a special flood zone. If you're also in a very high fire zone, that will require fire insurance, which can be even more on the higher end as far as costing. So we see that a lot in the hills of Piedmont, Montclair, and Oakland, some areas of San Carlos, San Bruno, like up in the mountains, we can see some high fire hazards. So it's always important to review this type of documentation, because that is going to be something that will be required by your lender. So something to take into consideration when you're offering, because you'll need that. You will not be required, even though you may be in an earthquake fault zone. A lot of the East Bay having the Hayward fault line, you will see some earthquake fault lines. It doesn't require you to have earthquake insurance, but it may be encouraged in the area. And then next steps on, once we've reviewed the disclosures, we understand the inspections, we've seen the home maybe a couple times, and we've decided this home is, at the top of our rating, we're going to want to prepare a winning offer. And so how do we compete in such a competitive, hot market? And so the first thing is making a great first impression. We do a number of things to make sure that we're making a great first impression. As the agent representing you, we always make sure that we're connecting with the listing agent, making that first impression by introducing ourselves, letting them know how much the buyer is interested in the property. But also, when we're submitting an offer, we want to make sure that we have our cover page, we have it presented in a beautiful package. And then if we're allowed, some sellers don't want to see them, but some sellers encourage them. We will include something that's called a love letter. It's introducing yourself and what you love about the home to the seller. Another thing that, as the agent representing buyers, that we're going to do is when we're speaking to that listing agent, we're going to determine, why is the seller selling? Like, what is motivating them? Is it just because their neighbor sold for a great price? And once they tell us that, we know that the seller's likely wanting that or more. Or is it they're moving closer to family? These are things that we'll be able to identify emotionally and financially. What is the seller looking for in a winning offer? Some sellers may be looking for what's called a lease back or a rent back. This means that a seller maybe needs some additional time after the close of escrow, that they may need to still live in the home while they're identifying the next home that they're going to move into. Maybe they're moving out of state or they need to finish up some ties with work, and it requires them to need some additional time after we've actually closed escrow, meaning the home is now ownership of the buyer, but we may still need time as the seller is finished closing up ties. And then another thing that can win an offer is shortening or waiving those contingencies that Jenny mentioned earlier. If we're able to waive those inspections because they provided them, you've already done all of your due diligence and provided Asad with all of your documentation. He knows that you're well qualified to get this loan. And we've looked at the recent solds in the neighborhood to know what's happening, and that our offer price and our purchase price is what other homes are selling for. We can shorten or waive those contingencies when we're offering. And so a lot of the items that we've been going over today are the requirements that we're going to need to submit that offer. So when we're submitting our offer package, we're going to have that pre-approval from our lender. We're also going to have what's called your proof of funds. Your proof of funds are verifying that you have the money to put in that down payment, the earnest money deposit, all of those liquid assets. You're going to want to provide proof to the seller that you have the financial ability not to just get the pre-approval from the lender, the financing from the lender, but you also have that ability to put down your down payment. So we'll want to show that to show them that you are financially stable. Along with that, we're going to sign those disclosures saying that we've reviewed all this documentation, as well as sign what is called the residential purchase agreement. And we'll be going through all of that documentation with you so you understand those documents that you're signing. And then the optional item would be that love letter written about you and what you love about the home. And then once our offer is accepted, we get into the escrow process. So the term escrow is what we use as the term from the day your offer is accepted to the day you get your keys. So when we do submit an offer, we're going to state how long we think we will be able to get this process done. A lot of that will be dependent on the lender being able to go through your file and get you through that process. Typically right now, I think Asad's been able to close a lot of our buyers in 21 days, which is fantastic in this market. Traditionally, we do see about 25 to 30 days. But when we're offering and we're up against, say we have $1 million offer and someone else has $1 million offer, but we're able to close in 21 days and their lender says 30 days, we are really standing out amongst those other offers. So that's another thing that can really make us stand out against our competition. So this process can typically take around 21 days to get all of these items taken care of. And we want to do them as in this order because some things can't happen until we do the next. So we can't really order the appraisal or get our homeowner's insurance or do any of these items until you submit that earnest money deposit, which right now we do see a lot of competitive offers stating that they can submit that within that first business day once our offer is accepted. And so all of these items, you'll have a team here to help you navigate. What should I do with homeowners insurance? What do I need and how do I get it? And then walking you through once we've done all of our application, doing our final walkthrough and really locking in all of the utilities, transferring everything and understanding that so that we can give you the keys on the day that we record. And then once we record, we get to celebrate. So these are just a couple photos of some recent clients that we've been able to help get into either their first home or their dream home here in the area. So love seeing these. A lot of happy faces.
And we'll open it up.
Yeah. I was gonna say, open it up to some questions. I think there was one question that I know of that we didn't get to address. I think Kevin has a couple questions regarding the VA loan. And so his first question is, when applying for a VA loan, do you recommend still shopping around for lenders? Like, can it be different, the lenders that you're working with?
Yeah, I can take that. Hey, Kevin. Yeah, I think it's a good idea to compare. Every lender is going to have some different areas that they're strong at. So it's a good idea to compare, particularly around VA loans. You know, you can just get a conversation going and compare what rates and options that are offered. In terms of guidelines, it'll be the same with all lenders, but you may want to just compare the rates between 2 or 3 different lenders when it comes to VA loans.
Any other questions? Feel free to type in the chat. And then if you can just give us an idea of like, hey, like in the current market right now, what are you seeing like with the types of different loans and should on a lender perspective, like should they buy now?
Yeah, sure. I can give you a little bit of insight in terms of what I'm hearing and seeing. The market has definitely picked up this spring season. So there is a lot of motivated buyers out there looking for properties. In terms of rates, they have gradually come up compared to where they were like early February, late January, because I think of the talks from the Fed about the next rate increase and potentially a couple of more. But I think what Jenny mentioned earlier is important to take note of is that if you really love a home and you're ready to purchase a property, you're not locked into the rate at this time. The sentiment also is from the Fed and a lot of different analysts that there will be opportunity to hopefully refinance into a lower rate in a couple of years. So you're not married to the rate, as some people have been known to say that. So I'm just going to take that quote out there too. So you definitely have the opportunity to refinance in a couple of years. The Fed will eventually stop raising rates. They'll take a pause. And if inflation is under control, we'll start to see some improvements in the rate environment. Most loans these days, especially with major banks, they're not going to have any prepayment penalties. So there's not going to be any restrictions or extra fees if you refinance out of the loan. And then in terms of some other products that are out there, as I touched on earlier, the portfolio jumbo has the better pricing, and there are some options on there for lower down payment. Some of my clients right now don't want to sell all their stock positions, so they are considering maybe a 10 or 15% down product. With our 10% down product with US Bank, I can speak to that right now. We can go up to 1.25 million loan amount. And a 15% down product, we can go up to a 1.5 million loan amount. And then with 20%, there's a lot more flexibility. We can go all the way up to 3 million loan amount with 20% down. I also do have some clients leverage their 401k to take a loan against it. If they're maybe short a little bit on a down payment, they're trying to get to the next tier. You can take a 401k loan. The typical rule on that is that you can take up to half the balance of your 401k as a loan, up to a maximum of $50,000. So since it's a loan, there shouldn't be any tax consequences or early withdrawal penalties. You'll just pay a specific rate based on whatever that brokerage firm who holds your 401k is charging. But it's just a different way that you can leverage your 401k and, you know, put some additional money down if you don't want to sell stock positions.
I think that's all the questions we have. So we'll wrap up here. And thank you so much, Asad, for all the knowledge. And thank you all for joining. And we'll check in and follow up with you guys individually to see if you have any specific questions and walk you through the Zillow calculator and figure out where you're financing and what your real estate goals are with buying, selling, or investing. Thank you all. Take care. Bye.
Thank you. Bye.